The bell rings, the screens flash, millions of retail investors open their brokerage apps. And roughly 90% of the available shares have already been sold to investors who are not them. Something happened the night before that exchange opened. Something that determined who got shares at what price before a single retail investor could place a trade. There are two prices in every successful IPO. There's the offering price, the price at which shares were sold the evening before trading began, and then there's the price you see on your screen when you open your brokerage app the next morning. In the most anticipated, most hyped IPOs, those two prices are not the same, and understanding exactly why is the entire subject of this video. There is a process that happens in the weeks before any IPO that determines who pays what price and who receives how many shares. Almost nobody outside the institutional world has ever had this explained to them completely and in plain language. This video is that explanation. We are going through every stage of the IPO architecture, from the moment a company decides to go public to the moment its insiders can first sell their shares. We are going through 4 verified historical case studies, both extreme ends of the documented outcome spectrum, presented with equal analytical honesty. We are going through what the long-run academic research actually shows about retail IPO buyer outcomes over 3-year and 5-year windows. And by the end of this video, you will have the structural picture, not an opinion, not a recommendation, the verified mechanics of a system that almost nobody explains this completely. Let's name these two prices precisely. The offering price is what institutional investors pay, set the night before trading begins, through a process we will cover completely. The first trade price is what retail investors encounter when the exchange opens. In successful, heavily anticipated IPOs, those two prices are different. The first trade price is higher, sometimes significantly higher. That gap, the difference between the offering price and the first trade price, is what financial media calls the first day pop, and it is one of the most consistently misunderstood mechanics in all of public markets. Most retail investors see the first day pop and interpret it as market enthusiasm, the market collectively deciding the company is worth more than the IPO price. That interpretation is structurally incomplete. The first day pop is not primarily a market signal. It is the mathematical result of how the offering price was set in the first place. We are going to explain that mechanism completely. And when you understand it, the entire IPO process becomes legible in a way it was not before. Before we do, here is what this video is and what it is not. This is structural analysis, the verified architecture of how the IPO process works. Nothing more and nothing less. This video is not an argument that retail investors should never participate in IPOs. The verified data contains examples on both ends of that question, and I will present both with equal analytical honesty throughout. It is not an argument that investment banks are corrupt, that the process is illegal, or that institutional investors are villains. Every mechanic we are about to cover is entirely legal and fully disclosed in public filings. And it is not financial advice on any specific company going public at any point in time. This is structural and educational analysis, applied to the IPO process as a system, not as a recommendation about any specific opportunity. What it is the plain language explanation of the architecture of how IPOs actually work, and specifically, how they work differently depending on which investor category you belong to. The way I see this, understanding how any financial system is actually built is not optional knowledge. It is the prerequisite for every rational decision you make inside that system. Most investors approach the IPO process from the outside as participants in a mechanism they do not fully understand. This video is built to change that. Let's start with the mental model most retail investors operate with when a major company announces its IPO, because this is where almost all of the confusion begins. Company decides to go public, file some paperwork, banks set a price, stock appears on the exchange. You can now buy it. That is the surface version. and it is missing almost everything that is mechanically important. The first distinction worth establishing clearly is the difference between the offering price and the first trade price, two numbers that are almost never explained separately in mainstream financial media coverage of any IPO announcement. The offering price is the price at which shares are sold to investors before the IPO opens for trading. It is negotiated and finalized the evening before the first trading day, through a process we are going to cover in complete detail. The first trade price is the price at which shares trade publicly on the exchange when it opens on day one. This is the price retail investors who were not allocated offering price shares will pay if they want to participate in the company's first day of public trading. In successful, heavily anticipated IPOs, these two prices are different. The first trade price is typically higher, and that gap is the first day pop that makes headlines every time a major company goes public. Here is the data on this gap that makes it worth paying close attention to. The historical average first day return in US IPOs, measured from the offering price to the first day closing price, has run at approximately 15 to 20%, according to data compiled in Jay Ritter's IPO research database at the University of Florida. That 15% to 20% is not random. It is not spontaneous market excitement. It is the mathematical result of the offering price being set deliberately below the equilibrium price suggested by institutional demand signals, and we will explain the exact mechanism that produces this. For institutional investors who received shares at the offering price, that 15 to 20% represents an immediate return on their position. For retail investors who buy at or after the open, that 15 to 20% represents a premium already priced in before their first trade executes. Which means, in the most precise framing available, the first day pop in a successful IPO is a transfer mechanism. The gain accrues to the institutional allocating. The investor buying at the open is funding that gain, not participating in it. And here is the data on this allocation picture that makes it even more precise. The verified historical institutional to retail share allocation split in US IPOs has run at approximately 90% institutional to 10% retail, according to data published by Fidelity Investments and Renaissance Capital. For every $1 billion of shares at the offering price in a typical US IPO, approximately $900 million goes to institutional investors, pension funds, mutual funds, hedge funds, insurance companies, and approximately $100 million goes to all retail investors combined. For the most popular, most oversubscribed deals, the ones generating maximum retail excitement, the retail allocation within that 10% is further compressed because institutional oversubscription reduces the pool available for retail allocation programs. The inverse relationship here is worth stopping on. The more desirable an IPO appears, the more media coverage, the more retail enthusiasm, the harder it becomes for a retail investor to receive shares at the offering price. The system does not scale with retail enthusiasm. It scales with institutional commitment during book building. Think about what that actually means. The most exciting IPO is structurally the hardest one for a retail investor to access at the price that generates the first day gain. The system does not reward retail excitement. It treats retail excitement as a demand signal that doesn't move the allocation mechanism at all. So when a retail investor watches the first day pop in a major IPO and asks whether they should have bought at the offering price, the prior question they readily ask is whether they could have bought at the offering price at all. In most significant IPOs, they could not. The question of where to buy was already structurally determined before they ever opened their brokerage app. And here is why this matters beyond the single transaction. The behavioral pattern of retail investors trying to participate in first-day IPO performance at prices that already reflect the institutional allocation premium has a verified long-run outcome in the academic data. We will cover that data in detail shortly. But first, the architecture, because understanding what creates these outcomes is more valuable than knowing the outcomes themselves. The architecture is the answer to every question about why the IPO process produces the outcomes it does. And this connects directly to a larger question, the question of how the global financial system is architecturally designed, who it serves, how it evolved, and what understanding that architecture actually gives you as someone operating within it. That question is exactly what I have built a complete course around. It is called Applied Macroeconomics, the Architecture of the Global Monetary System. 10 modules, over 2 hours of intentionally stripped, zero-fluff curriculum. The course covers the theoretical foundations of money, the central banking mechanism, the commercial banking credit system, sovereign debt and fiscal policy, the global macro landscape, commodities and hard assets, geoeconomics, economic cycles, and the future of the monetary architecture. Email support is included to get your specific questions clarified. And for those looking for an accessible starting point, more resources are also linked in the description. The link for the course is in the description below. Now, back to the IPO architecture. Because the offering price distinction is the first layer, what creates it is where this gets genuinely worth understanding. Every IPO begins with the decision the company's board and founders make privately, and it carries financial and operational consequences that extend years beyond the listing date. Companies go public for 4 verified primary reasons: to raise new capital for growth or debt reduction, to provide liquidity for founders and early investors who have been holding private shares for years, to create publicly traded stock usable in currency in acquisitions, and in some cases, to reduce existing debt obligations. What companies give up in the process is equally documented: quarterly earnings reporting obligations to public shareholders, ongoing SEC compliance costs, and the loss of strategic confidentiality. Every material business development now requires public disclosure. Research by Jay Ritter at the University of Florida documents that the average U.S. technology company in recent years has waited approximately 12 years from founding to IPO, compared to approximately 4 years in the late 1990s. That lengthening of the private to public timeline reflects a systemic shift in how institutional capital is available privately. Companies can now raise billions in private markets without the disclosure requirements of public listing, meaning the decision to go public is more deliberate and more strategically timed than it was 2 decades prior. The timing of the listing decision is itself a documented structural signal. Companies tend to go public when market conditions are favorable for high valuations, which means IPO activity concentrates during periods of market optimism, and the offering prices set in those periods reflect that optimism more than they reflect conservative fundamental valuation. The first formal action in any U.S. IPO is the filing of an S-1 registration statement with the U.S. Securities and Exchange Commission, the federal regulatory agency that oversees securities markets in the United States. The S-1 is the most important document in any IPO. It is publicly available from the moment of filing. It contains the company's full audited financial history, business description, ownership structure, executive compensation details, and, critically, the risk factors section. The risk factors section is the part of the S-1 where the company is legally required to enumerate every material risk to the business, every competitive threat, every regulatory exposure, every structural vulnerability that management has identified as genuinely consequential. It is, effectively, the management team's honest enumeration of what could go wrong. Most retail investors who follow IPO news never read it. Almost all institutional investors who participate in the roadshow have analyzed it thoroughly. There is also a filing mechanism called the confidential filing. Companies with under approximately $1.07 billion in annual gross revenue can submit an S-1 to the U.S. Securities and Exchange Commission confidentially before making any public announcement, meaning the IPO process can be weeks or months in active development before a single retail investor has seen a headline. Once the S-1 is in process, the company selects its lead underwriter, the investment bank that will manage the IPO, build the institutional demand picture, and distribute shares to investors. The largest IPOs are typically led by Goldman Sachs, Morgan Stanley, JP Morgan, or comparable major investment banks. Their institutional client networks are the mechanism through which demand for new shares is aggregated and priced. On large deals, multiple underwriting banks form a group called a syndicate, each bank contributing its institutional client relationships to the demand-building process and broadening the distribution across a larger institutional investor base. The underwriting fee is publicly disclosed in the prospectus. Fees typically run between 3.5% and 7% of total capital raised. On a $10 billion IPO, that translates to between $350 million and $700 million in fees. Compensation for a successful placement that shapes how every aspect of the process, from roadshow design to pricing recommendation, is structured. The roadshow is the 2-week period during which the company's management team travels across major financial centers, typically New York, Boston, San Francisco, London, and other institutional hubs, presenting the investment case directly to institutional investors. Who is in the room? Pension funds, sovereign wealth funds, hedge funds, mutual funds, insurance companies, and the most significant private capital structures. These are the investors whose demand signals will ultimately determine the offering price. Who is not in the room? Retail investors. The roadshow is exclusively accessible to institutional capital. It is the most information-rich event of the entire IPO process, and individual investors are not part of it. This creates the first measurable layer of information asymmetry. Institutional investors hear the management team answer hard, direct questions about competitive threats, about financial projections, about strategic assumptions under pressure. Retail investors read the press release. The quality of insight available from a direct roadshow meeting, the ability to push back on forward projections, probe competitive positioning, test management's assumptions under real questioning, is categorically different from what any public filing provides. And I want to be precise about this. The roadshow is an exclusive informational event that has no retail equivalent in the standard IPO process. That information asymmetry is measurable, it is verifiable, and it matters for how you interpret everything that follows. The allocation architecture we have been describing is specific to the US IPO market. It is worth being precise about how other major markets structure the same process, because the experience of a retail investor in India, for example, is meaningfully different from the experience of a retail investor in the United States. In India, the Securities and Exchange Board of India, SEBI, mandates a structured allocation framework for most book-build public offerings. Rather than leaving the institutional to retail split to the discretion of underwriting banks, SEBI defines it in regulation. The Indian IPO allocation structure divides available shares into 3 distinct tranches. The qualified institutional buyer tranche, typically 50% of the net offer. The non-institutional investor tranche, typically 15%. And the retail individual investor tranche, a mandatory minimum of 35% of the net offer for most book-built issues. That 35% mandatory retail tranche is a foundational structural difference from the US system, where the institutional to retail split is determined by the underwriting bank, with no regulatory minimum for retail allocation. For retail investors in India, the application process is also different. Individual investors apply for shares through a lot-based system, submitting an application for a minimum lot, which represents a specific number of shares. If the retail tranche is oversubscribed, meaning total retail demand exceeds the shares available, allocations are made through a computerized lottery. The lottery mechanism means that in highly anticipated Indian IPOs, the question for retail investors is not just what price they pay, but whether they receive any shares at all. A retail tranche oversubscribed by 50 times means the statistical probability of receiving an allocation in the lottery is approximately 2% per application. There is a structural pattern in this that mirrors what we established for the US market. The most popular, most heavily anticipated Indian IPOs generate the highest oversubscription multiples in the retail tranche, and therefore the lowest probability of retail allocation for any individual applicant. Enthusiasm reduces access. The pattern holds across both systems. The Indian listing system also has a different price-setting dynamic. In many Indian IPOs, particularly larger issues, the book-building process produces an offering price, and the stock begins trading on the BSE or NSE, the Bombay Stock Exchange or the National Stock Exchange of India, with its own first-day dynamics that reflect the demand levels in a preceding subscription period. The key takeaway from the international comparison is this: the specific mechanics differ by jurisdiction. The allocation percentages, the application process, the regulatory framework, but the foundational pattern holds across markets. The investors with the deepest access to the pricing process and the largest capital commitments consistently hold structural advantages relative to the individual retail investor. The architecture varies. The outcome pattern is consistent. There is already a full video on this channel about how the most sophisticated institutional capital structures, including family offices, approach the investment landscape and the access dynamics that come with operating at that scale. It connects directly to everything we have been covering here. Now we get to the architectural center of the entire IPO process, the mechanism that almost nobody outside the institutional world understands clearly, and the one that determines everything that follows: book building. Book building is the process by which the lead investment bank aggregates non-binding indications of interest from institutional investors, collecting data on how many shares each institution would take at various price levels over the course of the roadshow. These indications of interest are not public. The order book is invisible to retail investors. Nobody outside the participating institutions and the lead bank can see the demand picture being assembled. Institutional investors submitting indications are not simply specifying quantity. The most sophisticated are also signaling price sensitivity, communicating where they believe the company's value actually lies and at what price level their demand changes. Banks reward institutional investors who provide high-quality demand signals, large, committed indications at prices near or above the expected range, with favorable share allocations when the deal prices. This creates a direct incentive for institutions to reveal genuine pricing information during the book-building process. Academic research on IPO economics, including work published by J. Ritter and Ivo Welsh in peer-reviewed finance journals, establishes that underwriters deliberately incorporate only a portion of the positive demand signals from the book into the final offering price. The offering price is set below the equilibrium price suggested by the full institutional demand picture. The deliberate underprice rewards institutional investors who participated in price discovery with an immediate, near-guaranteed gain when trading begins, a compensation mechanism for their role in the information gathering process. This is not a concealed practice. It is described in academic literature, acknowledged in regulatory discussions, and represents the well-understood operational logic of the book-building mechanism, as it has for decades. The first-day pop is the mathematical consequence of this deliberate underprice. The amount by which the first trade price exceeds the offering price is approximately the return handed to institutional allocatees who received shares at the price set the night before. Nobody talks about this specifically. The financial media covers first-day pops as market validation, as the market enthusiastically greeting the new company. The architectural reality is that the pop is the reward for participation in a closed process that retail investors were almost never part of. And here is what most people miss about the first-day pop. It is not evidence of public demand. It is evidence of private supply restriction. Those are opposite signals, and almost every retail investor reads them the same way. And here is what makes this worth paying close attention to. The size of the first-day pop tells you approximately how much deliberate underpricing was built into the offering. A 20% first-day pop means institutional allocatees made approximately 20% on their offering price position before the first trading day ended. The IPO price is finalized the evening before trading begins. The order book closes. The bank sets the offering price, typically at the midpoint or high end of the initial range if institutional demand is strong, or below the initial range if book building revealed weaker than expected demand. Retail investors have had zero input into this price. They have not submitted demand signals. They were not in the roadshow meetings. The price is a function of institutional demand aggregation, and retail investors were not participants in that aggregation process. For retail investors to receive shares at the offering price, Their brokerage must have specifically negotiated retail IPO allocation programs with the underwriting syndicate. Most retail brokerages either lack these programs or have access only to deals where institutional demand was insufficient to fill the book on its own, which is itself a signal worth noting. The IPOs where retail investors can most easily get shares at the offering price are frequently the ones where institutional analysis produced insufficient demand to fully oversubscribe the deal, often for reasons that were apparent in the roadshow meetings that retail investors did not attend. The approximately 90% institutional, 10% retail allocation split is the historical US average. Within that 10%, retail allocation is further determined by account size, trading history, and the brokerage's specific relationship with the underwriting syndicate. Individual retail investors are, in the most precise framing available, competing for a fraction of a fraction, a portion of approximately 10% of a deal that has already been distributed based on factors entirely unrelated to their analysis of the company's fundamental value. On day one, the stock begins trading on the exchange. The first price is set by the matching of buy and sell orders in the secondary market, almost always opening above the offering price in heavily anticipated IPOs, reflecting the deliberate underprice built into the night before pricing. Institutional allocators who received shares at the offering price have a specific decision to make on day one. Some hold their position, some sell into the first day pop, capturing the allocated gain by selling to buyers entering the secondary market at the opening price. Retail investors who buy at or after the open are frequently purchasing from institutional investors who received shares at the offering price the night before. The pop is the institutional allocatee's return. The retail open buyer is on the other side of that transaction. Following an IPO in the United States, investment banks' research analysts are legally prohibited from publishing research on the newly listed company for approximately 25 to 40 days. This is the U.S. Securities and Exchange Commission mandated quiet period. The quiet period applies to the analysts who know the company best, the underwriting bank's research teams who were present throughout the preparation process and reviewed the financial documentation in depth. They are legally silenced, precisely when retail investors most want independent analysis. Independent research from analysts not connected to the underwriting begins to appear only after the quiet period ends. For the weeks immediately following the IPO, the analytical landscape for retail investors is deliberately constrained by regulation, even though that regulation exists for legitimate market integrity reasons. The lockup period is the post-IPO window during which company insiders, founders, early employees, venture capital investors, and pre-IPO stakeholders are contractually prohibited from selling their shares. The lockup period in most U.S. IPOs runs between 90 and 180 days. It exists to prevent the immediate market flooding that would occur if all insiders liquidated their entire positions on day one of public trading, a dynamic that would collapse the stock price before any market stability could form. The lockup expiry is a predictable event. The date is disclosed in the S-1 filing from the moment of first filing. Every market participant who has read the prospectus knows exactly when insiders can first sell, meaning it is a structural supply event with a known date, not an unexpected development. Research on lockup expiry dynamics establishes that stocks frequently experience downward price pressure in the periods surrounding the expiry date, as insider selling materializes, supply meeting demand on a known calendar date that was always available to anyone who read the relevant filing. Retail investors who purchase shares on or near the IPO date often hold through the lockup expiry, carrying a position through a predictable supply pressure event that was disclosed in the founding document of their investment from the beginning. One of the least understood mechanics in the entire IPO process is the over-allotment option, sometimes called the green shoe option, after Green Shoe Manufacturing Company, the first firm to use it in a U.S. public offering. The green shoe gives the lead underwriter the right to sell up to approximately 15% more shares than the stated IPO size. It functions as a price stabilization tool in the first 30 days of public trading. If the stock trades above the offering price, the bank exercises the option, creates the additional shares, and captures an additional underwriting fee on the extra volume. If the stock falls below the offering price, The bank uses the proceeds from its short position in those additional shares to buy stock in the open market, creating a price floor. This creates an institutional stabilization floor in the first 30 days. It is fully legal, fully disclosed in the prospectus, and practically universally unread by retail investors, who are interpreting day one and week one price behavior as a market signal about the company's actual value. Once the 30-day window closes, the green shoe expires. The bank's price support function ends. The stock's price is now determined entirely by secondary market supply and demand, without the institutional stabilization agent that was present for the first month. The final stage in the full IPO architecture is the secondary offering, which arrives months after the IPO, typically after the lockup period has expired and the company needs additional capital, or existing investors seek additional liquidity. In the secondary offering, the company sells new shares to public investors to raise more capital. For investors who bought at the IPO price and have held, a secondary offering represents dilution. More shares in existence means each existing share represents a smaller proportional ownership of the business. Secondary offerings are frequently priced at a discount to the current market price to attract sufficient institutional demand for the new shares, creating immediate downward pressure on existing shares that compounds the position of investors who purchased at the original IPO price. That is the complete sequential architecture. Every stage from the private listing decision through the post-lockup secondary offering, each one building on the previous, each one with verifiable structural implications for the retail investor that are almost never described comprehensively in a single place. Now let's be precise about what all of this produces when it runs in aggregate. Institutional investors can submit non-binding demand signals in the book-building process that directly influence the offering price and their allocation quantity. Retail investors, in the standard US IPO process, cannot participate in this mechanism at all. Institutional investors attend roadshow meetings and receive direct answers from the management team about the business's financial reality, its competitive threats, its growth assumptions, its risk factors as management understands them internally. Retail investors read the press release version of that conversation. Institutional investors receive shares at the offering price in proportion to the quality and scale of their demand commitment during book building. Most retail investors in the most in-demand IPOs either cannot access the offering price or receive minimal allocations through programs that work only for non-oversubscribed deals. Institutional investors have access to proprietary research from their bank's analysts, who have been reviewing the company's documentation in depth throughout the pre-IPO preparation period, research that exists before the public S1 filing is visible to anyone outside the institutional network. And institutional investors can coordinate exit timing in the first days of public trading before the quiet period ends, before broad public research forms a consensus view, and before the full retail investor base has had time to process the available information. What I want to be precise about here is this. The IPO process was not engineered with the specific goal of excluding retail investors. That framing overreaches the evidence. The structure evolved over decades. It evolved because institutional investors bring something the process genuinely needs: large capital commitments that anchor a deal, and pricing information from sophisticated analysis that helps set a rational offering price. The functional purpose of institutional involvement is real and on the record. The result of that functional design is a system where institutional participants hold measurable advantages across almost every dimension of the IPO transaction. The intent was functional capital formation. The result is unequal access. Understanding that distinction matters for how you interpret the system and for what kind of response it calls for. And here is where the behavioral dimension enters the analysis, because the structural picture alone does not fully explain the documented outcomes for retail investors. Knowing the structural mechanics of the IPO process intellectually is necessary, but it is not sufficient. The behavioral reality is that investors who understand the IPO architecture fully still find themselves drawn to first-day participation when a company they follow, believe in, or are excited about announces its listing. The reason for this is specific. There are documented cognitive patterns, studied extensively in behavioral finance research, that make the IPO environment one of the most reliably effective conditions for overriding rational analysis. Understanding them by name is more useful than simply knowing they exist. The first is the availability heuristic. When a major IPO announcement dominates financial media simultaneously, every outlet, every platform, every conversation, the sheer frequency of exposure makes the investment opportunity feel more significant, more validated, and more urgent than the underlying data may support. The volume of coverage functions as artificial social proof for the investment thesis. The second is social proof itself, the documented psychological tendency to interpret the behavior of a large group as evidence of correct judgment. When what appears to be an enormous number of investors want to participate in an IPO, the brain interprets mass participation as quality confirmation. This signal is particularly unreliable in IPOs because the institutional demand that drives the headline over subscription numbers is based on fundamentally different analytical processes than the retail demand that follows it. The third is recency bias, the tendency to weight recent experience disproportionately when forming expectations about future outcomes. In periods following several high-profile IPOs that produce strong first-day returns, the cognitive pattern of IPOs go up on day one becomes embedded as a near certainty. The academic data on long-run IPO performance, which operates on a 3 to 5 year window, is effectively invisible against the emotional salience of recent short-run examples. And the fourth is what behavioral researchers call the peak end rule, the finding that human beings evaluate experiences based on how they feel at their peak intensity and at their conclusion, not as an average across the full experience. An IPO announcement is specifically designed to create a peak intensity moment. The bell ringing, the stock price moving in real time, the social validation of participation. That peak intensity environment is the exact moment when careful analysis of the available public filings is least likely. These four patterns do not operate independently. They compound each other. Heavy media coverage creates availability. Apparent mass participation creates social proof. Recent positive examples create recency bias. And the opening bell ritual creates peak intensity emotional pressure. The IPO process, as it operates in practice, is one of the most complete natural environments for simultaneously activating all four cognitive patterns in the same investor at the same moment. None of these patterns are character flaws. They are documented features of human cognition, present in institutional investors as well as retail investors, though institutional structures create mechanisms to partially counteract them. Understanding them by name and function is the first step in building the systematic framework that holds under their pressure. There are two distinct gaps that require two distinct responses. The knowledge gap, not knowing what book building is, not knowing the allocation split, not understanding the quiet period mechanics, is one problem. The behavioral gap, knowing all of those things and still feeling the pull of urgency and excitement when a major IPO announcement fills every financial media outlet simultaneously, is a separate and arguably more persistent challenge. This video addresses the knowledge gap directly. Building the systematic framework that holds under emotional market pressure is a different but equally important conversation, and resources for that are linked in the description below. Almost nobody discusses both of these gaps together. Most IPO content either explains the surface mechanics without the architectural dark side, or dismisses the entire category without the nuance the historical data actually requires. The data does not support either extreme position. And before we go into the historical case studies, I want to say something about where this section is heading. Because if everything covered so far sounds uniformly negative for retail investors, the case studies are going to reframe that significantly. The historical evidence on IPO outcomes is not a single narrative. It is a spectrum with documented examples at both extremes. And one of the most important cases in IPO history is not one where retail investors lost. It is a case where a company decided the standard IPO architecture was unacceptable, and where two founders deliberately redesigned the entire process to give retail investors equal access at the offering price. That case is on the record. It worked, and it produced one of the most significant long-run investor outcomes in IPO history. We are getting there shortly. But first, the complete picture of what the standard process produces when it runs to its fully documented conclusion. Both extremes of the verified outcome spectrum deserve equal analytical depth, and that is exactly what they are going to get. The first case study is Facebook's initial public offering on the Nasdaq exchange on May 18, 2012, at the time, the most anticipated consumer technology IPO in history. Facebook priced its IPO at $38 per share, implying a market capitalization of approximately $104 billion. The offering raised approximately $16 billion, making it one of the largest IPOs in U.S. history at the time of listing. The offering had two structural characteristics that differentiated it from the typical book-built IPO and contributed directly to the outcome. First, the offering was priced at the top end of the initial price range, suggesting the offering price was set aggressively relative to institutional demand, leaving significantly less room for the deliberate underprice that typically creates a robust first-day pop for institutional allocators. Second, and this is where the Facebook case becomes a documented case study in infrastructure risk, entirely separate from valuation, the Nasdaq exchange experienced significant technical system failures in the first 30 minutes of trading on May 18, 2012. Trade confirmations were delayed for approximately 30 minutes. Orders that investors believed had executed were either unconfirmed or had filled at prices different from those intended. Major institutional participants, including UBS and Citadel, publicly reported significant losses attributed directly to the Nasdaq technical failure, losses that had nothing to do with the company's fundamentals. The stock opened at approximately $42.05, above the $38 offering price, but the first-day premium was minimal by historical standards, reflecting the aggressive pricing and the disruption created by the exchange's systems. Within approximately 4 months of the IPO, Facebook shares had fallen to approximately $17.55, a decline of approximately 54% from the offering price and approximately 58% from the first-day open price. For retail investors who purchased shares at or near the offering price in the weeks following the listing, the short-run verified outcome was a significant loss as the stock declined to approximately $17.55. This case cuts against a simplified narrative. In the Facebook IPO, retail investors received a relatively higher allocation than in many heavily oversubscribed deals, and the outcome was still materially adverse in the near term. Getting the shares was not the protection it might have appeared to be. The higher retail allocation was partly a function of the aggressive pricing compressing institutional enthusiasm at the margin, combined with the sheer size of the deal. Retail investors received more shares than usual, and those shares fell significantly below their purchase price within months. And now, the intellectual honesty this case requires. Facebook shares did not stay at $17.55. The company rebuilt its advertising business, expanded its product ecosystem, and generated substantial verified earnings growth in subsequent years. Investors who held Facebook shares purchased at the $38 IPO price through the subsequent decade generated substantial long-run returns as the business fundamentals materialized. The short-run IPO entry mechanics were adverse. The long-run business fundamentals proved exceptional. Both things are true, and conflating them, using the long-run business outcome to rationalize the short-run entry mechanics, is one of the most consistent analytical errors in retail IPO participation. The quality of the company and the quality of the entry point are two separate evaluations. The second case study is Uber Technologies' initial public offering on the New York Stock Exchange on May 10, 2019, and it illustrates a different and equally instructive failure mode. Uber had been one of the most anticipated IPOs of its period, a company that had grown to a scale, placing it among the most valuable private companies in the world, with a private valuation that had reached approximately $72 billion in its most recently documented private funding round before the public listing. The IPO was priced at $45 per share, already below the initially anticipated range of $44 to $50 per share. The downward revision was a direct signal from the book-building process. Institutional investors reviewing the roadshow had revised their demand expectations downward, and the banks adjusted the offering range to reflect the institutional consensus. The stock opened at approximately $42 on May 10, 2019, below the $45 offering price. For investors who received shares at $45, day one produced an immediate loss rather than the standard first-day gain. This was one of the most notable American technology IPOs to open below its offering price in years at that time. Within approximately 6 months of the IPO, Uber shares traded near $26, approximately 42% below the offering price and approximately 38% below the already discounted open price. For retail investors who purchased shares at or above the offering price in the weeks following the listing, the verified short-run outcome was a documented significant loss. The intuition that the offering price represents a rational institutional floor value, that the price reached through professional book building provides a sensible reference point, did not hold in this specific case. And here is why the Uber case matters beyond the single data point. The offering price is not a floor. It is the institutional consensus at a specific moment in time, shaped by the book-building process, the roadshow reception, and the market conditions of a particular 2-week window. It can be wrong. Institutional investors being wrong about a company's near-term fundamentals does not make the process corrupt. It makes it human. The verified pattern across IPO market history is that institutional enthusiasm and retail enthusiasm tend to peak simultaneously, at the exact moment when the risk of overpaying is historically highest. And now, the case that does not fit the narrative at all. One company decided the standard IPO architecture was unacceptable, and 2 founders took a direct decision to redesign the entire process from the ground up against the explicit preference of their underwriting banks. This is the on-record history of that decision. On August 19, 2004, Google conducted its initial public offering on the NASDAQ exchange. The company had been founded in 1998 by Larry Page and Sergey Brin as a search technology company, and by 2004 had become the dominant search engine globally, while generating substantial revenue from its online advertising model. Google's founders explicitly cited discomfort with the standard book-built IPO process in their S-1 filing, in the founders' letter included as part of the prospectus. They stated directly that the intended beneficiaries of the IPO were a wide pool of investors, not primarily the investment bank's institutional clients, who would capture the offering price allocation and the first-day premium under the standard process. So they did something no other major technology company has done before or since. They replaced the standard book-building mechanism with a modified Dutch auction. In a modified Dutch auction, every investor, institutional or retail, submits a bid specifying how many shares they want and at what price they are willing to pay. The auction closes. All bids are ranked by price. A single clearing price is established, the highest price at which all available shares can be sold. Every bidder at or above the clearing price receives shares at that single clearing price. Institutional investors and retail investors are priced identically. The offering price is not a pre-negotiated institutional number. It is the market clearing price of a transparent, competitive, open process accessible to any investor who submits a bid. The verified outcome: Google's IPO cleared at $85 per share. The stock opened at approximately $100 on the first day, a first-day premium of approximately 18%. In a standard book-built IPO of comparable scale, that 18% premium would have accrued almost entirely to institutional allocatees who received shares at the offering price the night before. In the Dutch auction, the premium was distributed to every investor who received shares at the $85 clearing price, including retail investors who had submitted bids at or above $85. What Google proved is specific and important. When the architectural barrier to retail access at the offering price is removed by deliberate design choice, retail investors can participate on equal footing with institutional capital. Equal access at the offering price is not a structural impossibility. It requires a deliberate choice that conflicts directly with the standard incentive structure of the underwriting banks, who preferred book building because it serves their institutional client relationships and produces the allocation dynamics that reward their most valuable clients. And it has been made deliberately by founders with the conviction and the leverage to override that bank preference exactly once in the modern era of large technology IPOs. The long-run outcome for investors who received Google shares at the $85 clearing price became one of the most cited positive results in IPO history, as the company's advertising business generated substantial verified earnings growth over the years that followed. The precise conclusion from Google 2004, equal structural access for retail investors at the offering price, is achievable. It requires the founding company to deliberately redesign the process against the bank's incentive structure. It has happened once. The standard process has remained standard. The fourth case study covers two parallel mechanisms that brought record retail participation into IPO-adjacent markets in 2020 and 2021, and the verified outcome data from both. The first mechanism was the traditional technology IPO market. Companies including Airbnb, DoorDash, and Snowflake went public at valuations most independent analysts at the time described as pricing in multiple years of future earnings growth. Airbnb priced its December 2020 IPO at $68 per share and opened at approximately $146, a first-day premium of approximately 115%. Snowflake's September 2020 IPO saw a comparable opening move. For institutional allokees who received shares at the offering price, these were extraordinary single-day returns. For retail investors buying at or after the open, they were extraordinary premiums already fully embedded before their first trade executed. This second mechanism was the SPAC, the Special Purpose Acquisition Company, a blank check company that raises capital through a public offering first, then acquires a private company later, allowing a private company to access public markets without completing the standard IPO registration and disclosure process. In 2021, approximately 600 SPAC vehicles went public in the United States, a record by a significant margin. The structure attracted substantial retail participation because shares could be purchased at a nominal $10 price before any acquisition target was announced, creating an apparent risk profile that looked different from the standard high volatility IPO. What many retail investors did not fully account for was the dilution embedded in the SPAC structure itself. Sponsor shares allocated at below market prices, warrant packages that created substantial dilution upon exercise, and earnout structures that systematically benefited the SPAC sponsor at the expense of long-term shareholders. The verified outcome data from both mechanisms is significant. The Renaissance Capital IPO Index, which tracks the performance of U.S. companies that went public in the prior 2 years, fell approximately 50% from its November 2021 peak to its 2022 trough, according to Renaissance Capital's published data. The average SPAC that completed an acquisition by early 2023 traded significantly below its merger announcement price, with multiple analyst reports and SPAC research data pointing to declines in the range of approximately 50% to 70% for a large portion of the completed deals. The foundational mechanism behind both outcomes was similar. Valuations were established during a period of maximum market optimism and historically low interest rates, conditions where price multiples expand significantly, and where the gap between offering price expectations and subsequent fundamental equilibrium is historically widest. The IPO activity concentrating at market cycle peaks is a consistent pattern across the historical record. The conditions that make it easiest to sell shares at elevated valuations are the same conditions that create the largest subsequent correction risk for investors who buy at those valuations. The cycle is documented. The pattern repeats. Now let's look at the aggregate picture. The 4 case studies cover specific examples with known outcomes. The academic research covers thousands. Jay Ritter at the University of Florida maintains the most comprehensive academic database of U.S. IPO performance available. His research, published across peer-reviewed finance journals spanning multiple decades, covers thousands of U.S. listings and their subsequent long-run stock performance measured against comparable benchmarks. One of the most consistent findings across this research literature is that IPOs as a group have historically underperformed comparable non-IPO stocks over 3-year and 5-year windows when measured from the offering date. The mechanism behind this pattern connects directly to everything we have covered. Companies tend to list when market conditions favor high valuations, meaning offering prices reflect optimistic market sentiment rather than conservative fundamental analysis. When conditions normalize, the optimism premium corrects toward the fundamental level. The long-run underperformance in the research data is, in significant part, the reversion of that optimism premium back toward fundamental levels, a mathematical consequence of timing the listing at the moment most favorable for the sellers, not necessarily for the buyers. But the same research makes a finding that the single narrative version of IPO performance obscures. Long-run underperformance is not uniformly distributed across all IPOs. The distribution has meaningful width. A subset of IPOs, typically companies with stronger verified fundamentals at the time of listing, more conservative initial valuations relative to their growth trajectory, and lower levels of pre-IPO media hype, has generated on-record long-run outperformance relative to comparable companies in the research. The challenge for retail investors is that the characteristics generating the most pre-listing attention, media coverage, brand recognition, consumer familiarity, narrative strength, are not the same characteristics the long-run data associates with IPO outperformance. The two sets of qualities are distinct, and treating them as equivalent is a consistent source of analytical error. The most widely covered, most consumer-familiar IPOs have historically produced the weakest long-run outcomes in the aggregate data. The correlation between media coverage intensity and long-run IPO investor return in the academic literature is negative. And I want to be precise about what that means, because it gets used to support an oversimplified conclusion. The negative correlation does not mean all high-profile IPOs underperform. Google 2004 is in the data. The finding is directional, not absolute. What it means precisely, the psychological factors that generate the highest retail excitement are not reliable proxies for the financial characteristics that produce long-run returns for public shareholders. Enthusiasm and investment merit are measuring different things. And here is where it gets genuinely counterintuitive. There is a finding in the academic literature that almost no mainstream IPO discussion includes. It doesn't tell investors to avoid IPOs. It tells them something more specific about when, relative to the IPO date, the documented entry conditions for retail investors have historically been most favorable. And the answer is not day one. Research cited across multiple academic finance publications suggests that purchasing shares of IPO companies approximately 6 to 12 months after the listing rather than at or near the IPO open has historically produced superior entry conditions for retail investors in the aggregate data. The reasoning is architectural, not speculative. 6 to 12 months post-IPO, several verifiable structural changes have occurred in the investor's informational environment. The lockup period has expired, and the initial insider selling pressure has largely materialized. Multiple quarters of public earnings data are now available. The company has reported as a public entity with real earnings calls, real analyst coverage, and real market reactions to positive and negative news. The initial hype cycle has faded, and the valuation has typically adjusted from the opening day premium towards something closer to the fundamental trajectory of the business. The information set available to the investor at that point is categorically richer than it was at the IPO date. Instead of analyzing one S-1 filing under significant time pressure with no historical public performance data, the investor at 6 months post-IPO has multiple earnings reports, a management track record on public guidance, market reactions to competitive developments, and the benefit of watching the stock price move through real conditions. That is a fundamentally different informational context for a capital allocation decision, and the aggregate performance data in the research literature suggests it produces measurably different outcomes relative to first-day participation. And I want to be precise about the limitations of this finding. It is a documented aggregate pattern. Whether any specific company provides a superior entry point at 6 months post-IPO versus the IPO date is a function of that company's specific fundamentals, the valuation at each point, and the market conditions at each moment. The aggregate pattern does not apply uniformly to every individual case. There is also an alternative IPO structure worth knowing: the direct listing. In a direct listing, no new shares are created and no underwriter allocates shares. Existing shareholders, founders, employees, early investors sell directly into the public market at whatever price market supply and demand establishes on day one. Companies that have conducted notable direct listings include Spotify in April 2018 on the New York Stock Exchange and Slack Technologies in June 2019, also on the New York Stock Exchange. The direct listing mechanism eliminates underwriter fees, eliminates the book building process, and eliminates the deliberate underprice that produces the first-day pop for institutional allocatees. The trade-off is specific. No new capital is raised for the company itself in a standard direct listing, and the price stabilization function of the underwriting syndicate is absent. For companies that do not need to raise new capital and only need to provide liquidity for existing shareholders, the direct listing has real functional advantages. The direct listing is not widely used for large technology IPOs, primarily because it eliminates the investment banking fee structure and the institutional client benefits that the standard book build process produces. Its relative rarity is itself a data point about whose interests the standard process is organized around. So, what does an investor who has absorbed the complete architectural picture of the IPO process actually do differently? This is the question the structural analysis alone does not fully answer. And I want to be clear about how to read this section. What follows is not a prescription and not financial advice. It is structural analysis of how informed investor behavior, as described across the academic and practitioner literature, differs from the typical retail IPO participation pattern. The first element is the S1, specifically the risk factor section. Companies are legally required to enumerate every material business risk in this document, and it is publicly available from the moment of filing to every investor who wants to read it. The primary information source for most retail investors about a pending IPO is the roadshow narrative, the optimistic management case built to generate institutional demand. The S1 risk factor section is the honest counterweight in the same public filing. Investors who read both are working with the complete picture. Those who read only the narrative are working with the edited version. Beyond the risk factor section, the S1 contains 3 additional areas that informed analysis requires. The first is the management's discussion and analysis section, the MD&A, where company management is required to explain the drivers of their financial performance in their own words, including which revenue lines are growing, which are declining, and what assumptions underpin their forward projections. The second is the revenue concentration disclosure, specifically what percentage of total revenue comes from the top customers. A company generating a large proportion of its revenue from a single customer has a verified concentration risk that the headline revenue growth number does not immediately reveal. This information is in the S1, not in the roadshow summary. The third is the burn rate and cash runway disclosure. For companies that are not yet profitable, and many IPO stage companies are not, the S1 contains disclosures about the rate at which the company is consuming cash and the period for which its current cash position is sufficient to fund operations. A company with limited cash runway has a specific and verifiable financial pressure that the listing itself is partly designed to address. That context matters for evaluating the offering price. The fourth is the related party transactions section, where the company discloses all material transactions between the company and its founders, executives, or major shareholders. These disclosures reveal the financial relationships that exist above the level of the ordinary investor, transactions that may have been struck at terms not immediately visible in the headline financial metrics. Reading these 4 areas, risk factors, MD&A, customer concentration, and related party transactions, takes time. It may take several hours for a complex filing. That time investment is precisely what the compressed window of an IPO announcement is designed to prevent. The S1 has been publicly available for weeks, but almost nobody reads it. Reading the S1 is not about finding a reason to avoid an investment. It is about understanding what the company's own management has identified as the material threats to the business thesis, the specific scenarios under which the investment case fails. That information exists. It is in the same document as the optimistic projections. The second element is the lockup calendar. The lockup expiration date is disclosed in the S1 from the moment the company first files. Investors who note it before purchasing are tracking a predictable supply event, a known date when additional selling pressure may materialize, rather than discovering it as an unexpected development. The third element is fundamental valuation evaluation. The IPO price implies a specific multiple applied to the company's verified financial metrics: revenue, gross margin, growth rate, free cash flow trajectory, all of which are in the S1. The question of whether the implied multiple is consistent with the verified fundamental trajectory is answerable from publicly available data. The challenge is that performing this analysis requires time. The emotional architecture of an IPO announcement specifically does not give retail investors. The roadshow window, the pricing night, the opening bell, all create time pressure that compresses the analytical window precisely when careful evaluation is most necessary. That time pressure is not accidental. The IPO process creates urgency, social proof, and excitement at the exact moment when unhurried analysis of available information would be most valuable. The environment serves those selling shares more than it serves those deciding whether to buy them. The fourth element connects to the knowledge and behavioral gap we established earlier. Understanding the structural mechanics is the knowledge layer. Developing the systematic framework that holds under emotional market pressure is the behavioral layer. The capacity to apply structural knowledge when the circumstances are specifically designed to override it. The veridical aspect of the inner circle groupings is the intellectual blueprint for all of their activities. And we found that the corporate commitment to terminating sexual exploitation is intellectually flawed. What knowledge changes is the decision-making context. An investor who understands the structural dynamics is equipped to evaluate their actual position within the system, rather than operating under assumptions about equal access that the data does not support. The architecture is asymmetrical. The analytical framework for operating within that asymmetry: reading the full S1, noting the lockup calendar, evaluating the implied fundamental valuation, understanding the post-IPO information timeline, is accessible to any investor willing to build it deliberately. That asymmetry and that framework are the complete picture. One without the other produces either passivity or overconfidence. Both together produce the position most accurately described as informed participation in a market where not all participants start from the same place. Let me bring this together. The IPO process is a 12-stage architecture that begins with a private listing decision and ends with post-lockup secondary offerings, each stage with measurable implications for the retail investor's position that are almost never described comprehensively in a single place. At every stage, the verifiable advantages of institutional investors over retail investors are disclosed in public filings and described in on-record academic research. The allocation split, the roadshow access, the book-building information asymmetry, the quiet period analytical gap, the lockup timing dynamics. None of these are concealed. The gap is not a secrecy gap. It is an attention and priority gap. The information is there. Almost nobody reads it. The historical case studies gave us both documented ends of the outcome spectrum: the standard architecture producing adverse near-term outcomes for retail buyers in the Facebook 2012 and Uber 2019 cases, and the one case, Google 2004, where two founders found the standard architecture unacceptable and redesigned it with retail access as an explicit structural goal. The long-run academic data adds the aggregate dimension, the on-record pattern of IPO underperformance in the 3 to 5 year window from offering date, the distribution within that pattern, and the architectural rationale behind the post-IPO waiting period finding. And what all of this adds up to, in the most honest framing available, is a system that serves important functional purposes, that was built around the institutional capital it needed to function, and that was never primarily organized around the retail investor's experience. Understanding that is not pessimism, it is structural literacy. And the question of what to do with that understanding is individual, specific to each investor's knowledge, framework, and decision context. It is not answerable generically from the outside. The complete picture is not a reason for pessimism about public markets. It is a reason for precision. There is a difference between a system that is unfair and a system that was designed around a different primary constituency than you. The IPO process was designed to efficiently allocate capital from investors who could anchor large deals and generate pricing information, and it does that function well. The byproduct of that design is unequal access. Understanding which of those is primary changes how you interpret every IPO announcement you will encounter from this point forward. So, when the next major IPO announcement hits, what does an investor who has absorbed all of this actually do? The structural analysis does not give a single answer, it gives the framework for finding one. And here is what I think is the most honest closing thought on this entire subject. The investors with the best on-record long-run outcomes in IPO markets are not primarily the ones who maximize their offering price allocation on day one. They are the ones who understood the structural picture, what they were participating in, at what price, at what stage of the company's public life cycle, before they made their decision. That is what this video was built to give you, the structural picture, the complete, verified mechanics of a system that processes significant capital annually, presented as completely and as honestly as the data allows. Not a recommendation, not a prediction, not a guarantee of any outcome. The architecture of the system, in plain language, for any investor who believes that understanding how a system is built is the necessary starting point for operating within it with any degree of clarity. If you made it to this point, and you have, it tells me something specific about what you were here for. There are more videos on this channel built around exactly this commitment to structural understanding over surface-level coverage. The ones appearing on your screen right now go into the same depth on other foundational layers of the global financial system. If this kind of analysis has been useful, the like and subscribe cost nothing, and make sure you see the next one when it comes. Thanks for watching.